Hi guys, good afternoon and welcome to the CNBC TV18 Mumbai newsroom. I'm Pavitra, with me is Sonal, and we also have Feroz Aziz with us in the studio. So Feroz, thanks a lot for joining us. We have a very interesting topic to discuss, Sonal, which is on basically how all of these new investors are investing and what's perhaps a good approach.
Oh yes, so Gen Z is the term we've been using, right? Feroz, thank you so much for joining us. And that's the real question, what next for the next generation? The recent study by CAMS and CI also indicated that millennials are the one who are putting higher amount of money in mutual funds. So why do you think the Gen Next or the Gen Z is stepping back? What is the reason why big chunk on investments are going from the millennials itself? What could be the reason here?
See, Gen Z is a large part of the audience is still studying maybe. They've not joined the workforce. So you will always want to compare a 25-year-old and a 25-year-old. So if you want to understand how Gen Z will behave in the next 10 years, you see how millennials have behaved for the last 10 years. If you look at the growth of the millennials investing, that's been stupendous. So when I expect a 25-year-old to move to a 35-year-old, it's a very promising situation. So the growth rates of the millennials have been almost about 19-25%. Those are very healthy growth rates. Will the Gen Z behave similarly when they come to 35, which they will, right? In the next 10 years, we will still call them Gen Z, but they will be 35-year-old. Someday a Gen Z will be a 90-year-old man or a lady if the longevity is that much. That's point one. Point two, when you're young, as a behavioral pattern, you love to have more uncertainty. You like the excitement, right? You will not see a 70-year-old man sitting on a roller coaster. To magnify the example, a 19-year-old in a Ferrari world is couldn't get more exciting for him, right? So if there are other alternatives which can give you that excitement on a day in and day out basis, like a crypto, a mutual fund is definitely one of the most boring long-term investments, right? The NAV movements are going to be second decimal. Here you see that you get that every tick. So they crave for excitement. That's one reason. But I'm very hopeful that this educated lot, when they mature, they will behave far better than the current millennials as they move. That's the basic hypothesis.
No, I completely take your point, and you know, this is why there was that report during COVID as well, right? There are a lot of first-time investors, very young, lot are investing in cryptos, in NFTs, in all kinds of pudgy penguins and things like that, right? But tell us, so then let's not differentiate as Gen Z and millennial. Just tell us, for a young investor that's getting in, what do you think is a good investment approach to start off with?
See, if you want to understand what are the basic, youngsters should generally have a thought process of trying to see, let me not rediscover mistakes. So first thing is to internalize patience. How much can patience pay? So let me illustratively tell you that if you did 5 SIPs in 25-year-old funds, not the best ones, just arbitrarily picked, you would have made a 1,000 rupee each SIP to 3 crore odd lakhs in 3 crore rupees. So that's a reasonable growth, which is an 18%, in which you have a 13% fund, you have a 21% fund. So once a youngster internalizes this number, his patience shoots up. That's the most important thing. Otherwise, and these 25 years have not been a smooth ride. It's not been a linear. Those millennials who would have actually been there investing, they've seen a global financial crisis, they've seen a COVID, they've seen a tapering. Every year market found something to be scared about. But if somebody actually went through that journey, 5,000 rupees is what you end up spending on a dinner today. So that's first element of internalizing the emotional aspect. The second is you try and simplify your life. You use EPFO for your debt allocation and mutual funds for your equity allocation. And if you still want to quench your thirst for excitement, carve out 10% of your money. And that'll still give you the excitement, but not impact your long term. We have to empathize with them, right? If you are 20-year-old, if somebody's saying you're going to only have boring stuff in your portfolio, that's incorrect for us to even give that advice. So what is that amount you're carving out of your disposable income? Is 10%, 20%? But at least have a limit to your adrenal quenching.
Okay, so we need to take care of the emotional quotient while taking care of the intelligence quotient as well, right? We take that point. So in that case, say, tell us what could be the do's and don'ts for Gen Next investing. Of course, we are talking about next 10 years being the investment period for them. They're more tech savvy. Their savings preference, as you said, is very different. Consumption patterns are different. So just the basic do's and don'ts here.
See, I'll spend a minute on one of those do's and don'ts, because those are all carved out of a lot of experience. So now, never mix insurance and investments. It's heard several times by experts, but I'm going to give some numbers so that the retention of this principle is larger longevity. So we have an insurance exit department for the last 8 years. So every year they exit insurance policies, audit them and exit them. So last year we exited about 1,072 policies with 149 crores held for 9 years. The IRR of all these 1,072 is 3.33%.
That's it?
Okay, this is real numbers, right?
Yeah.
Now, nobody can dispute that whether it's good or bad. 3.33 is not even half of what Government of India could have given you after holding it for 9 years. So that's one thing you never mix. The second is your parents, at least our parents who came from the previous generation, had this whole counseling that yaar jitni chadar ho utni phailao, pehle property kharid lo, घर नहीं है तो कुछ नहीं है, रोटी कपड़ा मकान, because they came from the survival of the fittest.
Yeah.
Millennials would be the parents, maybe, of these Gen Z. So don't fall for this trap, at least now, that you first time buy a property and give away all your disposable income to that EMI. We have a real estate exit department for 10 years. And in the last 1 year, we've exited about 47 properties and the IRRs have been 6.99 after a holding period of 14 years. Because builders make fancy presentations. Right? If you go count, if I would have asked my dad what to do with my money, he would have surely said, "Itna acha ghar mil raha hai, idhar swimming pool bhi hai, kharid le." Right? Don't fall for that trap. It'll suck out all your money. And several, don't compromise on your liquidity. Don't underestimate the power of scheme selection. Look at MF Corner and select a good scheme. People have overdone this bait, saying asset allocation is the 90% job. Scheme selection is very critical in equity mutual fund. The best one has generated 38% for the last 5 years compounded. The worst one has generated 4% compounded.
Yeah.
Okay.
Right? So scheme selection is important. Don't underestimate that power. The age-old saying asset allocation theek ho gaya, the sab theek ho gaya, may not be right.
Okay, that makes complete sense. In fact, I'm actually going to come back to you on what kinds of, themes and what categories of funds also maybe a younger investor should look at. But before that, there's been so much talk about gold, right, with prices at these elevated levels. So for someone that's getting into gold now, you want to take us through whether physical gold is the right choice? Should you look at, the safe sovereign gold bonds? What would you recommend here?
I'm now going to give you pointed answers.
Yeah.
I've made a large monologue. So I would say if you're going to be investing for gold, short term, it is ETF, which is the best way. If it is sovereign gold bond, if it's long-term investment.
Yeah.
Digital gold, I don't believe in because you don't get the extra return for the risk you take. If you're giving your money to a corporate, then there are other elements of risk which come other than the gold prices, which is credit risk and stuff. So no digital gold, it might, however easy it might be. If you can't collect money for a gram, then wait for 3 months, collect that for a gram and buy a sovereign gold bond.
Okay, that was, we've kept it so precise. I was like, okay, the answer is over, but yeah, makes sense, right? Digital gold does have a lot of storage costs there as well. So the risk return reward is what you've explained here. But Feroze, we will continue this chat. Before that, we'll slip into a short break. On the other side, this interesting chat about how to invest if you're a first-time investor, especially in the day and age that we are in. Stay tuned for that. Welcome back. You're still tuned into Mutual Fund Corner and we still have with us Feroze Aziz and we're discussing everything which is Gen Next investing. And one factor or one trend that I've seen, and that was according to the Scams report as well, debt funds are still not very popular. Investors or millennial investors contributed only 3% and invested only 3% versus 90% in equities in their entire investment amount. What should the idea about debt funds be? How much should it be as a part of your overall portfolio, especially when you're going for this first-time investing?
See, I think if you look at debt, debt is a sure shot way of destroying value if it's long-term money. Okay, because there's no way that in 10 years, 20 years, earnings growth are not going to supersede debt returns, right? If those companies which can't grow at 10, 12% will no more be a part of Nifty, right? Naturally, over a period of time. So there's a self-correcting mechanism. So point one, if you're looking at your debt proportions, look at the overall portfolio. This is the biggest mistake people do. They don't count their PPF monies, their EPF monies, their other traditional insurance plan. If you've actually got into that trap, then that's still a debt. So count it on your overall portfolio and it should never supersede 20% for a youngster. Looking at the overall portfolio, which might mean zero in debt funds, be it as it may. If 20% is already allocated, which most youngsters will have, because their salaries, compulsory deductions could be there.
So it's not only the mutual fund portfolio, the entire saving that you have should be only 20% in debt.
That makes sense. And also, we were talking about how it's not exciting enough. I think this just does not, create that kind of excitement for someone new, right? Where you feel like it's giving me this kind of return. You just feel like if you have that longer time horizon, you should be able to get more, right?
Yes. And if you look at one of the reports of what is India making, there's one CRISIL report which says how has India allocated the money, and we calculated the return of that for the last 10 years. Retrospectively, it was 6.7%. So whoever is going to tell you don't take the risk has never taken the risk, so he's not qualified to tell you. So the biggest problem is that you might be counseled by people to not take the risk because they've not seen the benefit of taking the risk anyway.
Okay, that point is completely taken. Another thing, so like you mentioned, that you already have some amount of exposure because you're right out of college, you've got your job. Now, for someone who's right out of college, they just got their first job, they want to create a portfolio of schemes. What would you recommend they do?
So firstly, if you've just got a job, take a chill pill for 6 months.
Enjoy.
Get rid of all your pent-up demand. Okay, so that you have a timeline for it. Rather than living like that for 5 years, you at least say 6 months, I'll be a spendthrift. But this is my timeline. Could be the first financial year, you let go. Then you have the capability to change behavior after that. So point one is have your expense and investment ratio. Investment upon expense can never be less than 1. Right? Your denominator can never be greater than the numerator. If you can keep that. The second thing which you have to definitely do is set an EMI to expense ratio. Right? That should also not exceed more than 1. Because denominator is expense in both these cases. Right? It's lesser the better.
Okay, all right. So that is what you need to do. Did you also wait for 6 months after your first salary before?
I may or may not have waited a little bit longer than that. But, it's good that we say this as well, right? I mean, you don't need to highlight that you need to start saving the second you get your first salary. It's important to have fun also.
Okay, so continuing that question itself, when we are talking about younger investors going out, what would the portfolio look like? Say, if we want to talk about differentiating it into schemes. You said scheme selection is very important as well. Something that you would suggest here to the young investors who are watching us, and what will the initial portfolio look like, as Pavitra was asking?
See, firstly, you have to know what not to do. Focus is the art of knowing what to ignore. That's one of the key elements in investing, right? If you try, you'll feel like doing a lot more. So point one is a technology fund will appeal to a youngster, right? Those are not great foundation stones of the portfolio. There are 8 categories which mathematically give you the best risk-adjusted return. Okay, and it's provable mathematically. So which are those 8 categories? You can look at a large cap, lowest weightage there, large mid cap, flexi cap, multi caps, contra, dividend yield. So there are some categories. So you will not, as a new investor, you don't need all the categories. So first is get yourself a flexi cap and multi cap to begin with. Both these categories, when you look at the data from when these categories were formed in 2018, we did a study. Now, for example, flexi cap, 40% of the schemes, 40% of the total flexi cap schemes have outperformed their benchmark. They've outperformed it by 6% every year. Whereas in the large cap category, 37% of the schemes have outperformed, but only by 3%. So flexi cap is clearly better in terms of the number of schemes which outperform. And if you get lucky to be in those 40%, what is the extent of benefit you get is 6%. So that's the basis on which I'm saying these could be the 2 great start points. If those are the only 2 SIPs you have, then flexi and multi-cap have done justice to people's money from 2018 when this categorization came into existence and SEBI brought in the favor of clarity for all investors.
Okay, that makes sense. I'm going to take some more help from you and really get into it. Could you name some schemes for us and, just tell us if someone is watching, they don't want to go and study all of these schemes. Do you want to just name those for us?
Yeah, sure. Category-wise, and I'm keeping a youngster in mind. And one more thing I'm keeping in mind is not retrospective return, prospective return using some degree of models. So Aditya Birla Small Cap, HDFC Flexi Cap, HDFC Small Cap, Quant Active, and Kotak Multi-Cap Fund. Okay, so if you just look at the retrospective rear view, you may be disappointed with why were these schemes recommended in the first place, right? Aditya Birla Small Cap, for example. It's not the best past performing scheme, but if you go individually in each stocks, and like you guys track so many stocks, right? Each of them have a target. If you try and make target NAV, these fare better. That's why these schemes.
Okay, those are some interesting names and, will be very helpful for young investors who are watching us as well. Apart from, say, equities or debt, is there something that the investors should definitely have in their portfolio? Of course, there are not many categories that we can look at. You spoke about gold. At this day and age, when we are looking at record highs in gold prices as well, is that something we can still buy as an investor? Would you prefer that?
If a lady is asking me this question, I better say yes. Okay, and I'm sure you're going to say yes, mathematically as well. Yeah. There's evidence that if you look at gold today, in rupee terms, it's at the peak. But it's still not somewhere outrageously expensive in dollar terms. So that's a good sign for somebody to begin. And the best part of gold is you're getting a gift of 4% every year. How 4%? 2.5% in terms of interest and tax-free returns, because you have 8 years. As a youngster, you have 8 years to hold the bond. So point I'm trying to make is if you get an arbitrage extra return of 4% every year, that's a large gift. So sovereign gold bond for the long-term investment becomes very meritorious because gold itself gives 9.3% 3-year rolling return. If you add 4% gift, then the break-even for the other assets to fight that asset becomes very difficult, right? Because if you have zero capital gain and if you have made even 10% return, that means you're saving 2% every year. That's what sovereign gold bond is, the only non-capital gain instrument today available in India.
Okay, got that. Another category that, you know, a lot of young investors, when we ask them questions on our social media, tend to send in is on international funds. Do you think that this is a good space for a, you know, relatively young investor to be in?
I would say no. Even I don't have one international fund and I've not missed them at all. Unless you have a global goal and you don't know where you're going to accumulate those dollars, and if you're living hand to mouth and you know that I will have to accumulate dollars, then international funds could be meritorious.
Very rare case.
Very rare case. And I think India growth story is far better. India's alpha story is far better because those guys will not give you better return than the index, point one. Point two, when you go global, you don't know what you're buying. People bought NASDAQ funds left, right, center. How counterintuitive. You're trying to reduce risk by going out, and then you're buying the most volatile index, right? It's like counterintuitive. So I would say keep it simple, get your foundation right, then you can, the 20th slab can be a little more exciting.
20th slab, that sounds interesting. Okay.
Right, of a building. So I'm saying the foundation has to be
I
more
thought in terms of income as well, the 20th slab will be so far, right? And of course, the tax collected at source has been increased from 5 to 20%. International investing will only make it to more expensive, right? You know, we have some time, so I wanted to ask you this trend amongst Gen Z, and that's climate change. So they speak about ESG funds very highly. But is that a category? It's not picked up so much. So do you think it's still somewhere where investors of this age invest?
No, I think you should never invest. See, you are still earning, right? People don't start with philanthropy, right? Right? I can expect a Warren Buffett saying I'm writing off all my income, but I wouldn't expect him to do it at the age of 30. If Nifty has outperformed the SGX index, ESG index of 100, Nifty 100, by about 8%, you can't afford to be generous today, right? And ESG, I would not recommend for the moment. In fact, now all the companies who don't have a large growth story, they're trying to get a marketing story by being ESG compliant. It's basically hygiene, right? How can you not be environment? It's a basic way you have to run a listed company. I don't think it's something fancy. It's just a marketing term. So if I know I'm a very large corporate and I don't have a 20% growth to show as a mid-cap stock does, I have to at least look fancy by being ESG compliant to attract more money.
Okay, so ESG funds not
saying it as I'm seeing it.
That's the best
way,
part.
Right?
I'm just going to try to squeeze in one last question since we have you know, a minute left on this show. There's been so much talk about sector funds, thematic funds, especially when the market is moving like this. You know, we've seen a pickup of certain sectors very prominently. Do you think someone who's getting in, who's maybe a little bit well versed with the markets, not enough to select his own stocks, but do you think sector funds are a complete no? Because I mean, in a sense, you're still taking a bet on a certain sector for sure, so you have to know a little bit. But do you think this is a good place to be?
It is a good place to be if he is a loyalist viewer of yours. I'm being honest with you. So because an exit is also going to be very critical. If you're thinking I'm going to buy a sector fund, do an SIP and open it after 10 years, you would have taken 2 times more the risk to generate the same return. So if you're ready to commit that time, saying that today, okay, technology is down and out. 1 year back, it was really good. So people were buying at that time. Now when I see inflows in technology funds, when there is a screaming buy, people don't buy. But you'll have to actually exit it at the right time as well. So
Yeah.
commitment to listening to you has to be high.
And to you.
Yeah, especially you. So yes, timing is very important. Feroz, it was such an interesting discussion from insurance to gold to equity to debt. Covered everything. Definitely investing 101 for not only next gen, even for the current generation. So thank you so much for joining us today. And with that, it's a wrap on this edition of Mutual Fund Corner from Pavitra, myself and the entire team. Thank you so much for joining us. Closing bell will come in next for the last hour of trade.